Thanks, David, and welcome everyone. It's my great pleasure to be here today addressing this very important launch of the new social capital residency. I think it's a fantastic step and an exciting time in South Australia's history. As an economist, I like lots of charts and numbers and graphs, so I try not to bamboozle people with too much of that, but nevertheless we'll have a few of them just because I think it helps to tell a bit of a story of where we've come as a state and as a society and where we might be heading. I guess the first thing to keep in mind is that in the scheme of things, we're a fairly small part of a national and international economy which has been buffeted in recent times by the global financial crisis, and I think there's been a lot of talk about the timing of the recovery from the GFC, from sort of unfolding in late 2008, what it means for us. I think if you look at this chart here, this just shows you this is global growth of the world economy, and those dotted orange lines are the forecasts for where the growth was expected to be in 2011, and then below that 2012, 2013. I think the picture there is sort of pretty clear that, and this is the International Monetary Fund forecasts, that all of the forecasts about the pace of global recovery from the GFC, now with the benefit of hindsight, seemed more over-optimistic at the time. And I think I was showing this chart to a colleague the other day, and he pointed out that if you look at what's happened to growth in wages, it's been a very similar, the shape of the chart looks exactly the same, and those of you that are sort of employing or working, I mean, we're all aware that sort of wages are growing at a much more sedate level than they have in previous years. You can see that reflected also in the, this is looking at gross state product, which is a measure of our output as a state, in the red line there. It bounces around a bit from year to year, as indeed the yellow line does at the national level. The key thing there is that the growth rate in both South Australia and Australia, since in the sort of last 8 or 9 years there, has been quite considerably lower than it was in the preceding period, and also below the long run average. So what's driving that growth or slower rate of growth, I should say, in the economy? If you compare the average contributors to growth on the left-hand side there, we've got the growth from 95-96 to 2005-06, and then on the right is the 10 years after that, so the most recent 10 years. So this reflects state-level GSP average growth declining to, I think it's about 2.1%, which is that red dot there. Private consumption has remained relatively stable as a contributor to GSP. Public consumption and public investment about the same. The big drop is private investment, which is that grey bar. We think that private investment accounts for sort of the majority of that slowdown in growth. CEDA, the Committee for Economic Development of Australia, has suggested that what this really relates to is businesses not yet having adjusted their expectations to fit, a new normal, or the new world we are in now, which is lower yield, lower growth, lower interest rates, and that's being reflected, I guess, in the lower rates of private investment. This all sounds a bit depressing. We get on some more positive stuff in a minute, so bear with me. But there's also been, I think, if you look at what's actually happened to disposable household incomes in Australia since the GFC and in the period before, so the red bars there on the left, that's the period from 97-98 to 2009-10, which is the period when sort of before the GFC really started to unfold. And there was growth in each of those 5 quintiles. So quintile 1 is the sort of the lowest 20% of incomes nationally. Quintile 5 is the highest quintile. In the years following the GFC, immediately following, that's the orange bars, this was the period when Australia was still supported at the national level by a mining boom, and of course we had fiscal stimulus, which was very effective as well in maintaining, making sure that Australia didn't have that sort of massive dip in GDP that most other advanced economies around the world did, those two things together, there was a drop. And I think the interesting thing there is that the drop was much more pronounced across all of the income quintiles. So, I mean, there's a broader story here about a longer term, a less even distribution of wealth, so that people on lower incomes tend to grow at lower rates than people at higher rates, who are on higher incomes to begin with. But in the years post GFC, you can see that slowdown in disposable household incomes has been much more apparent right across the board, including in the higher income quintiles. And I think probably if you think about some of the sentiment that's driving some of the changes in the world we see at the moment, what's some of the political movements, the sentiments behind Brexit and the election of President Trump in the US, and even perhaps closer to our own shores, this is perhaps explaining part of the sort of, the party's over. We've had good times for a long time. It's now we're sort of, there's this feeling of less prosperity, particularly at the personal level. Next slide really just shows you that the growth in GSP, which is that red line at the top, hasn't necessarily been reflected in a growth in employment, which is the orange line, and ours underneath that. So the economic growth is increasingly being decoupled from employment growth. Now, partly that's to do with changes in productivity in firms and in industries where jobs that previously were very labour intensive are now being replaced by automation and software and so on. Partly, I think it's also about what's happened in the mining industry, where we had a lot of investment in exploration and construction, which was very labour intensive. A lot of that's now moved towards the production stage and exports, which generate a lot of growth in exports, but not necessarily employment. Now we come to the good news. So over the year to March 2017, if we look at trend total employment in South Australia, we've actually seen 19 consecutive months of growth, which is a pretty impressive story. If you look at the red line there, which is South Australia, where in fact second only to Victoria if you compare the outcomes. So we're sort of, in terms of trend total employment, we're right up there at sort of peak levels, which really I think speaks to not only sort of the resilience, the underlying capacity of the economy to absorb some of the job losses that we've seen in automotive and a number of other industries, but it also reflects a longer term story about the nature of employment in the economy. Where are the jobs coming from? We've got a chart here going back over the period from 1997 to 2017. So this is over a 20-year period. And this is those figures on it, so I should have a header there, but that's percentage of total employment in the economy. So back in 1997, manufacturing was the largest sector. It was back up around above 14%. In fact, if you went back to 1965, manufacturing accounted for 36% of total employment in South Australia. So this is certainly part of a much longer term trend. But the employment in manufacturing has been gradually replaced by the emergence of growth in jobs in other industry sectors. So the healthcare and social assistance sector, which is that blue line, has been the fastest growing. We've also seen a lot of growth in the professional, scientific and technical services, which is that sort of dark brownish line, third from the bottom. And a lot of that reflects the, if you like, the smart part of manufacturing. A lot of modern manufacturing in advanced economy is not about assembly line workers sticking bits together, but it is about the design services, the maintenance, the solutions, areas where we have some competitive strengths in this state, and also growth in education and training. But if you just look at that blue line there for a minute, the healthcare and social assistance sector as defined by the ABS. This slide here shows you the breakdown of where those jobs are. So it's a big sector. It's over 11% of our economic output, at about 15% of total employment, according to the latest figures. We did some analysis on this a year or two ago to try and work out exactly where these people are working, because it's a lot of people, and we reckon that about roughly a third of that employment is in the sort of SA health units, ambulance, disabilities, families, domiciliary care and housing SA, which as we know is a sort of is a sizable part of employment, but it's only about a third of that total. There was a study done by SACOS a couple of years ago which was looking at employment in non-government organisations and service providers, and they reckon that we think that's probably about another third. And there's another third which we assume is private providers, so they're not government employees, they're not NGOs, they might be private health providers. But there's been a big growth there in sort of red line there, residential care services, medical and other allied health services, but childcare services, a whole range of different areas contributing to that growth. Just quickly as well, if you break down employment not by industry sector but by the type of jobs, whether it's sort of, the two biggest growth areas there, the red line, are in professionals, which includes in health but also in ICT, business, HR, marketing, design, engineering and education, but also in community and personal service workers, which is that orange line sort of second up from the bottom, the one that's been growing there. And this includes roles such as carers and aides, hospitality, health and welfare and support workers. So, the evidence is very clear this is a large and growing section of the economy, and I think if you think about a lot of those roles, these are job roles that all require there's a strong human service component. They require strong interpersonal skills as well as technical skills. They're probably less likely to be affected by digital disruption than some of the other occupation groups. Looking at ageing here, we hear a lot about the ageing of the workforce and what does that really mean. I think in the past, the sort of common narrative about ageing was that people used to think about older people as being a burden on the economy, as though you move sort of automatically and systematically and completely from the productive part of the economy once you retire to being in the at age 65 or whatever, to being in the non-productive part. Well, I think this chart here shows fairly clearly that idea of people moving into retirement at age 65 is well and truly gone. The grey line at the bottom on the left there just shows 65 to 69-year-olds, how that number has increased both in terms of as a share of the population and as a share of the labour force. And if I showed you the picture for 70 plus as well, it's a similar sort of thing, lower but big growth. It does mean that the average age of workers is increasing. It means that the nature of work is changing. The nature of people's jobs is changing. People are increasingly working part-time. The challenge, I think, for employers is to come up with new ways of sharing jobs in this new type of sharing economy, so that the wealth and the income is distributed more equitably, and to ensure that people have the possibility of remaining engaged in the labour force and in society in different ways for longer. Lastly, I've just got some brief comments to talk about the growth in impact investing globally, which is a sort of an exciting new area with our new Aspire Social Impact Bond in South Australia, which is the first in Australia that targets homelessness, but it is part of a worldwide movement. So according to Social Finance in the UK, there are now 74 social impact bonds that have been announced. $278 million in private capital has been raised through those products, and over 100,000 lives affected by the programs that have been financed. Now, those numbers, I think, are still, they're big numbers, but they're sort of nowhere near as the amount of capital that's available globally now to be invested in new products. There's been quite phenomenal growth in the number of institutions, whether it's superannuation funds, private ancillary funds, benevolent societies, in making funds available to be invested in these new types of social programs. lastly, I've just got a quick summary. The Economist Intelligence Unit last year did a sort of a global ranking of where different countries stood in terms of social innovation in general, and Australia ranked reasonably well 7th in both Pillar 2, which is the financing, and Pillar 4, which is the sort of social support, but not so well on the policy and institutional framework and the entrepreneurship. So there's certainly been growth in Australia, but in the global scheme of things, there's certainly, I suppose, room for advancing. So I'll just leave it there, perhaps. I'm happy to take any questions if anyone has any.